Okay, what if I told you that the scariest thing for any investor, a big market crash, was actually the best thing that could happen to your money? I know it sounds completely backward, but stick with me. In this explainer, we're going to break down the surprisingly simple logic that can turn market panic into your single greatest wealth building opportunity.
Just let that sink in for a second. This one idea that you should actually be excited when everyone else is freaking out is exactly what we're going to unpack. I mean, how is it even possible to see a crash as a good thing? Well, the answer lies in a pretty powerful paradox.
And this is what I like to call the market crash paradox. On the surface, seeing your portfolio bleed red just feels awful. But hiding right underneath that immediate fear is a massive opportunity, especially for anyone who's in this for the long haul.
Right, this is the big question, isn't it? It goes against every single one of our instincts. The market tanks, your portfolio value shrinks, and your gut is screaming at you to do something, to just panic. So how do we flip that script? How do we turn that fear into a real advantage? Well, it turns out the answer is already built into a simple automatic process.
That process is what we'll call the automatic advantage. Think of it like a built-in feature of a really common investment strategy that turns all that scary market volatility from a threat into your best friend, all without you having to lift a finger.
The secret has a name. It's called Rupee Cost Averaging, or RCA for short. And honestly, it's incredibly simple. All it means is that you invest a fixed amount of money on a regular schedule, say every single month. You don't try to guess if the market is high or low. You just keep investing consistently. That's it. That is the entire strategy. And here's the best part. If you're already using a systematic investment plan, an SIP, you're already doing this. An SIP is basically an engine that's designed to put rupee cost averaging on autopilot. It's already working for you right now, behind the scenes.
Let's look at how this works with some really simple numbers. Let's say your monthly SIP is a fixed 10,000 rupees. In a normal month, a unit of your fund costs 100 rupees. So your 10 grand buys you 100 units. Simple enough. But then, bam, the market crashes, and the price gets cut in half, down to 50 rupees. Your automatic 10,000 rupee investment still goes through, but this time it buys you 200 units, double the amount.
And this right here is the whole magic trick. For the exact same amount of money, you just bought twice as many assets. While everybody else was panicking about the price drop, your automated plan was quietly snapping up investments at a massive 50% off sale. Now, when you see how that simple math works and you imagine it happening over and over again, it completely changes how you think about volatility. This one mechanical advantage creates a huge difference in how investors behave and, more importantly, in their final results. You can really see the two different paths here. You've got the panic seller. They see the crash, they get scared, and they stop their SIP. Or even worse, they sell everything at the bottom. They lock in their losses and they totally miss the ride back up. Then you have the disciplined SIP investor. They do nothing. They just let the system work, automatically buying more and more units at a discount, which perfectly positions them for huge gains when the market eventually recovers.
And hey, this isn't just some theory. History proves this out time and time again. The 2008 financial crisis, the 2013 taper tantrum, the COVID crash in 2020. For disciplined SIP investors, these weren't disasters. They were some of the best opportunities to load up on assets on the cheap, which led to them massively outperforming everyone who paused out of fear. So this brings us to what's probably the most important part of all, the psychology. The math is easy, right? But the real challenge is just sticking with the plan when every emotion in your body is screaming at you to sell. It all comes down to mastering your own mindset. I absolutely love this insight, which is inspired by the financial writer Morgan Housel. Look, you have zero, and I mean zero control over what the market does next. But the one thing you have absolute control over is your own behavior, your decision to just stay invested and let time and compounding do their magic. So if there's one thing you take away from this, let it be this. The biggest threat to your long-term wealth isn't a market crash. It's your own impulse to hit pause on your SIP right when it's doing its most important work. That emotional reaction, that is the true enemy of compounding. All right, so how do we actually put this into practice? How do we make sure we're the disciplined investor and not the panic seller? Here's a super simple 3-step action plan you can follow. First, automate everything. Let your SAP do its job so you take emotion completely out of the equation. Second, reframe your thinking.
When you see the market is down, don't think I'm losing money. Think everything's on sale. And third, verify it. Don't just take my word for it. Go pull up your own investment statement from a crazy time like early 2020 and see for yourself how many more units you bought when prices were in the basement.
And that brings us to the final question. The market will drop again. That's a guarantee. The only thing we don't know is when. The only real variable is how you're going to react. So, the next time it happens, what are you going to see? Panic or the biggest sale of the year? Your answer to that question could literally define your financial future. Thanks for tuning in.